Guys, these are 3 stocks that I will buy in June of 2024 if, and the big key is the if, the prices make sense. Hell, I'll buy them tomorrow if the prices drop by 20% overnight. Stock number 1, Adobe. Guys, I've talked about how I think Adobe and Microsoft are the 2 best software businesses out there. This company, major fluctuations in price, all-time high in 2021 of $700 per share. Currently at $488, but here's what I love about Adobe. $222 billion market cap, which is all the shares being bought, versus $229 enterprise value. That $7 billion difference is the debt. And look at their free cash flow last year, $6.5 billion. Speaking of free cash flow, $6.5 billion last year versus $4.8 billion of net income. 5-year average free cash flow, $6.1 billion versus a 5-year average net income of 4.6. If you're new to this channel, I love when free cash flow is greater than net income. It shows me that people are always going to look at the net income, but that cash coming in is so much better. And that's going to be able to provide the lifeblood for that business. Now, just because I'm looking at Adobe doesn't mean you should have it right on your radar. Use it as a way of saying, hey, what does Paul see in this? What do I see in this? I'm here to teach a process that you can learn and apply to any investment you do in the future. But those investments you make have to apply to your life. They have to be the right thing for you. So let's see how Adobe is doing here in terms of the 8 pillars. Guys, love these 8 pillars, and here's why. Everything's a check mark except for the 5-year P and 5-year price to free cash flow. So even though this check mark is here for shares outstanding, they've bought back 6% of their shares in the last 5 years. That's not necessarily a good thing if the shares are very expensive. Now, just because there's X's here on the shares on the pillars does not mean that this company is expensive. And again, look how much lower the price to free cash flow is than the PE, which we love. Remember, if a company is going to grow 100% a year for 10 years, I would pay this premium all day long for that company, all day, and as should you. And if you sit here and look at analyst estimates, look at these analyst estimates. They have earnings per share growing at 12.5, 13.5, 15, 11, 14.5. They're analysts, and it's not all of them. I do get that. But you look at this and think to yourself, okay, there's a lot of growth here in profit. This company deserves a premium. The question is, how much of a premium? I currently have puts on Adobe for $4.25 per share, and I think $4.35. I have 2 levels. What this means, for those of you who don't know what that is, if Adobe falls to $4.25 or $4.35 by June 7th and 21st, I think are my dates, I get the shares at those prices. And I will be glad to take those shares at those prices, and here's why. Let's go look at our stock analyzer tool. The last time I did Adobe, I did reasonable revenue growth, 6, 10, and 14. Might be aggressive on the high side, but I'm okay with that. Profit margin, not really focused on because it's a free cash flow business. And my free cash flow, 38, 40, and 42. And I put my PE and price of free cash flow at 18, 21, and 24. And my desired return at the market of 9%. So no margin of safety. And as you can see, I have my free cash flow value of 567 on the low side. So at 425 to 435, out of a 567, I have over 20% margin of safety. And I'm good with that for a growing business that's high quality and really great gross margin. Stock number 2, Ulta Beauty. Disclaimer, guys, I actually own it right now, and I'm hoping to add more to it in June. And I have puts on Ulta as well. But remember, just because I own a company or somebody on the internet does, or even some super investor like Buffett, Spear, Monish, all these guys, don't buy a company just for more of those reasons. I see everybody on Twitter hyping about Costco because Munger talks about what a great business it is, and it's $800 a share now. I just think it's far too overpriced. Just because a business is high quality and somebody you respect owns it, you don't know when they bought it, why they bought it, any of these things. So don't go jumping into it right away. We're here to teach that process with Ulta Beauty. Here's what I love about Ulta. This is a retail business. $18.6 billion market cap versus enterprise value of $21 billion. That's a $3 billion difference. And their average free cash flow was $1 billion in the last year, and the average was 911. Look at this return on invested capital. 24% over the last 5 years, 30% last year. High quality business, it's retail, and most importantly, they're growing their same store sales by 4 to 6% a year. That's incredible for a retail location. And this debt of $3 billion for a retail business. That's absolutely incredible. Let's go check out these 8 pillars. 8-pillar thriller. And they're buying back shares. Again, seems reasonable maybe with that high return on invested capital, 21 times 5-year earnings, 20 times 5-year free cash flow. So their 5-year free cash flow is better than their 5-year net income. Top quality business, guys, 40% gross margins, 10 to 12% profit margin. Man, this is an incredible, incredible business. Analyst estimates. Earnings per share going from 26 to 43 in the next 5-6 years, 11, 6, 8.5, 13, 15.5, and 11.5% earnings per share growth. And in terms of revenue, guys, look at this revenue growth. 4 to 7% over the next 5 or 6 years. So, not a grower, but if you buy this company at the right price, if the price continues to fall, not only should you buy more shares as long as the thesis is the same, but also the company should be buying back more shares and giving us investors a bigger piece of the company. So let's see what price we want Ulta at. Like I said, I currently own it and I want to buy more shares here. Now, I put in 3, 5, and 7% revenue growth. I did 9.5 to 11% profit margin, same with free cash flow with a middle number of 10.25. Now for PE and price of free cash flow, even though it's a top quality company, it's still retail. So I want to be a little bit cautious. So I put 15, 18, and 21. Now, one can make the argument for those of you who have the software, you could make the argument, Paul, just put in whatever PE you think, but put in a higher margin of safety, a higher desired return. Very valid. But it's still retail, and I just want to be a little more conservative. I put 9% desired return in. Again, no margin of safety. Hit the analyze button. Guys, I have a low price of $335, a high price of $650, a middle price of $470. If I bought at today's price of $379, it's about a 12% return if my middle assumptions all occur. And that's what's key there. So again, if you like Ulta, if you sit there and you like the business and it fits what you're trying to do, you should take a further look into it. Don't buy it just because I do. But I'm hoping. And if you're buying this and you don't want it to go down, don't buy it. I'm hoping this thing falls even further. I hope we have a bad bear market that takes out 50% of the value of this company. I will buy more shares. And hopefully, Ulta will continue to buy more shares. And as you guys see, with all these companies, I mean, look at Ulta. Look at the volatility. Year to date, it's down 22%. 3 months, down 31%. That's some big drops. All-time high was 2 months ago at 575, and it's at 378. That's a drop of, what, 35%? That's a huge drop. And that's what makes investing so difficult. Most people have the brain power to invest. Very few people have the stomach to invest. And I'm hoping that you're the kind of investor who's buying dollar cost averaging into a low-cost ETF, and then along the way, adding pieces of companies that you like that fit your criteria. That's what we're trying to teach here, is that process to do so. So if you want to surround yourself with the same kind of investors who can help the emotional journey be much better and help your analysis be much better, click the link below. We have a trial for our software, our community. You get the community of thousands of like-minded investors, plus all of our tools, all of our software. Go check it out. I think it'll really help the way in which you invest. Third company took a big hit yesterday. Target, down to 142. Look at Target. All-time high of 250 in 2021. And look at this. All-time 52-week high was just 7 weeks ago at $181 per share. In the last 1 month, it's down 14%. The last 1 week, 11%. Now, Target's interesting, and here's why. Target was down almost 10% yesterday, and this is what they reported. They beat on sales estimate. They barely missed on EPS. They beat on gross margin, and they barely missed on comparable store sales. The stock was down 10%. This is your opportunity. If you love Target at 150, 170, 180, why would you not love it today? We always talk about taking... Now, is the future of Target tough? Yeah, maybe it is. Walmart reported same-store sales growth, but Lowe's and Home Depot are not. Same thing, declining for them as well. This is a concern. Don't get me wrong, but I look at the world of Target saying, do I think Target will be around in the next 10, 20 years? I really do. Yes, retail is changing, but it's not going away. And I think Target is adapting very well to the idea of online purchasing. You should hope this keeps driving prices lower. Prices got as low as like 105 on Target recently. that's an opportunity for the astute investor to get in. So what's my value on Target? Let's take a look at it right here. Actually, let's look at the 8 pillars first. All right, debt. When it comes to retail, it doesn't worry me as much because a lot of that debt's in there. Cash flow is down $275 million versus net income being up $875 million. And there is a discrepancy between their free cash flow and their net income, but not enough to make me worry. 15 times 5-year PE, 17 times price to free cash flow. You should want that lower. If the stock went back to $100 a share, that would be almost a third. We'd be down to 13 times free cash flow. For me, the story will sit there and say why it's down so much, why it's terrible. For me personally, that's what I'd love to hear on companies that I think are going to be around for a long time. I still think Target will be around. Could it end up being like Kmart? Sure. But I don't think it'll end up being that way. I think they do a good job of partnering with the right people like Starbucks and Ulta, trying to get more women in the store, and women love Target. So let's look at analyst estimates. Even analysts have growth of 50% from $8.40 per share to $12.26 in the next 5 years. Again, not for sure, and they're analysts. They can make these modifications for a long time. Revenue growth, decline, and then back to growth. And guys, remember, inflation will help a company like Target out. It'll drive their revenue up. That's a big key for why inflation helps companies like this. So, what's my value on Target? Well, you guys can see my assumptions here. I'm putting in my 9%, no margin of safety in here. I still think actually 15, 18, and 21 times earnings and free cash flow isn't necessarily the right number. I think it should be higher, but I'm staying there for right now. I hit the analyze button. I have a low price of 130, a high price of 230, middle price of 175. I have it on my watch list at 135, so I'm selling puts on Target very soon. Guys, I'm hoping that it drives down that price and gets below that 130 to 135 number. Thank you very much. Make sure you click the link below to join our inner circle. Take care.